Morning, everyone. Fred White will be acting chair for today's board meeting. Courtney, could you call the roll?
Certainly. Ms. Cabildo? Mr. Cervantes? Undersecretary Grant for Secretary Moss?
Present. Good morning.
Ms. Limon?
Present.
Ms. Wyant for Treasurer Ma?
Here.
Mr. Prince? Here. Mr. Russell?
Present.
Mr. Fiegels for Secretary Sin?
Present.
Ms. Sotelo?
Present.
Director Velasquez?
Here.
Chair White?
Here.
Mr. Williams?
Here.
Mr. Acefa? Ms. Peralt for Director Stevenshaw? And Ms. Franklin?
Present.
Chair White, we have a quorum.
Thank you, Courtney. Item number 2 on our agenda is the approval of the minutes and our board workshop in March. The minutes were provided in your agenda package for your review. I will entertain a motion to approve minutes.
Good morning. So moved.
But don't we just typically accept as presented?
If there are no questions or comments,
That'd be great.
meeting minutes approved. Item number 3, chairperson, executive director comments. I'll make this brief, but I'd like to acknowledge the staff as each of you engage and participate in the marketplace through conferences, panels, ideation, discussions. I'm hearing about you in my daily professional life and see you participating in these events. And I want to applaud the staff and the leadership for being a part of the industry in such a meaningful way. Today's board meeting is going to involve 3 action items, approvals for multifamily transactions. And we'll have 3 different presentations from staff regarding capital markets, policy issues on the federal, state, local level. So looking forward to hearing it. And I'll pass it over to Rebecca for comments.
Thank you, Dr. White. I want to start off my comments today talking about the reorganization and the proposal for the agency in which we work with and work under, the BCSH. And so we're very excited about this change. It's kind of progressed as the kind of different months and has gone on. But I'm going to have Undersecretary Grant start us off with kind of just an overall update.
Wonderful, and good morning, everyone, again. And we are indeed very excited about the reorganization of the Business Consumer Services and Housing Agency. Yes, big name. And back in January, the governor had proposed the splitting of the agency where we would take one side and be very consumer focused and the other side being very housing focused. And so there is a proposal that's before the Little Hoover Commission, as well as the legislature as of today. There's been countless hearings already in the legislature. There's been at least 2 hearings in the Little Hoover Commission. And there will be a report submitted to the legislature at the end of this month, probably early June to be exact, by the Little Hoover Commission. And then the legislature will have another 30 to 60 days to review the proposal. At which time, if there are no rejections of the proposal, it will go into effect July the 5th. And so we are very excited. There's a lot of discussion that's occurred, lots of collaboration amongst our BCSH departments, Director Velasquez, and a lot of great partnership with HCD and thinking about, excuse me, just what the future holds. If all goes well, the proposal names that the new agency will be created and established in July 1 of 2026, and BCSH will be dissolved. And so just excited, just want to give folks a brief update that it is true. There is a proposal underway, and we just look forward to future updates down the road. Thank you.
Thank you so much. And as I said before, we're very excited about having a opportunity to really have focused energy and focused leadership around housing and kind of all that it entails for the state of California. I know that Director Velasquez and I were asked by the Assembly joint hearing to kind of speak on behalf of the split. He's done a lot more talking about it than I have. But we're very excited to kind of have this really focused energy around housing and kind of a recognition that it is, one of the top issues, if not the top issue for the state of California. I would also love to update the board on some of our successes in our single family program. As you guys know, that the My Access program opened up on March 17th, which gives an enhanced down payment assistance to home buyers. Also, it has that kind of the operations in the background of that program was led by our financing department in the issuance of $50 million in taxable bonds for funding that program. I know that Director Tam's going to have an update kind of later in the day on the agenda, kind of more detail on that. So I'm not going to steal his thunder, even though I make better lemon bars. But kind of like as far as impact for the program, we are seeing a lot of activity in the inland areas of the state, which isn't surprising. It's something that we figured which would happen due to the affordability of the homes and the pricing for our, the balance between, first-time home buyers, what their income and purchasing power is in the home prices in those areas. So a little bit of color to that. The Central Valley is our top region right now for the My Access program at 29%, followed by Inland Empire at 22%, and then the Capital Region at 20%. Most of the homes are single-family units, though wanting to highlight that the My Access program does unlock the ability to finance HUD-approved mobile homes. So we haven't necessarily seen an uptick in those purchases yet, but that financing model that enhanced down payment assistance does unlock that ability for homeowners who find that to be an option. Also in the single family space, we are, as part of the full implementation of the Dream for All program, we are working to stand up a product that would provide borrowers with a refinancing option. So Dream for All borrowers do have the option of doing a one-time refinance. And so we want to be able to offer that with our within our own program. The goal is for this effort to enhance our ability to fast track the first mortgages associated with the Dream for All shared appreciation loans. I think it's also good for us to be setting up these kinds of programs within our single family space so that if we wanted to branch out farther than Dream for All, we'll have kind of the operations behind that. Moving over to multifamily and the mixed income program, or MIP. Last meeting, I did share that we had a record-breaking 48 applications received. I also can now talk about the preliminary awards that we did. So there were 12 of those 48 that earned a preliminary award. The 2025 group has a lot of large developments, so a lot of really big unit counts coming in for those developments, which we expect to see the construction of 2,319 new units of mixed income affordable housing through the MIP 2025. I also want to say that we did, when our criteria for MIP, make some changes to accommodate and recognize the disasters that and the fires that had happened in the Southern California region, and as a result of that, kind of the changes to criteria, of those 2,300 units, 1,000 of those units will be in LA County. Oh, wow.
So
really excited about seeing that the production there and being, first at the table on the rebuild option for units in LA. So we're very excited about the preliminary scores and kind of what those units represent. So now moving on to a topic I'm very familiar with is the CalAssist program. We are going to have a presentation on that. A little bit more detail for the board on kind of what the CalAssist Mortgage Fund looks like and the criteria. Just to high level remind the board, that is the new mortgage assistance program that we have the board approved back, I think, in March through the governor's office's proposal for us to allocate the NMS or National Mortgage Settlement Funds to help not only LA County victims, but anyone who was a victim of a disaster throughout the state of California in the last couple of years. I also want to say that we're going to be hosting a launch event in Southern California. I think it's specifically in Altadena on June 5th, and cordially inviting all of you to be able to attend if you would like. We can send out more specifics, but that would be June 5th in the Altadena area. For any board members who would like to attend the launch event, I'll be there. So, also, as if anyone watched or was a participant in the audit committee, we got good news last month that CalHFA's annual comprehensive financial report again has won an award for its 8th consecutive year. It just recognizes GFOA, or the Government Finance Officers, honors organizations that demonstrate effective financial practices as well as clarity and transparency in reporting. It's a high mark for the transparency and the quality of our financial reporting. And obviously, we know financial reporting is essential when we talk about ratings, bond issuances, the agency's ratings, et cetera. So, really, and it's not an easy task to be able to collect all the information timely, put together a very comprehensive financial report. So us winning this award, it's not a check the box. The 8th year was just as much effort put in by the team and, hard work. So glad that we're there. Also, my last kind of updates is it's conference season. So as I kind of have my opening thing is, since the vacant executive director's seat is vacant, they've let me out of the office and I get to hit the conference scene. So in late April, I was joined by Director of Multifamily Programs, Stephanie McFadden, at the National Housing and Rehabilitation Association's Spring Developer Forum. I was also joined by Ms. Wyatt at that opportunity. Then in May, Director Velasquez joined us as a trio at the Nova Grata Conference in San Francisco. Both conferences, we were focusing, kind of talking about the policy changes and the outlook that our different organizations see going into the next year. And, we're talking about the struggles around, financing and, kind of the unknown and uncertainty the market has in our ability to execute kind of an underwrite and timeliness, et cetera. But also I tried to highlight is CalHFA is looking for opportunities to expand our multifamily lending outside of the LIHTC world. We're never abandoning LIHTC. We love it. But we also want to make sure that we are able to use our ability as the state of California's affordable housing bond issuer and lender to be able to kind of go into these niches that maybe we can help, but not normally the normal constructs. And Director Prince always is pushing us to be more innovative and thinking out of the box. So we finally listened after a few years and really are trying to do that. Oh, okay, 12 years. I've only been here for 4, so I can't, But we really are trying to do that. And the first step in kind of that is engaging with the development community, the developers, the syndicators, and understanding where their projects are stuck and what's going on and seeing what we can do. I think I've talked about a lot about this, and my background is in human-centered design and understanding what people's problems are. And so that's kind of the step that we're taking in the multifamily space. It's led by obviously Stephanie McFadden, and she's fantastic. If you ever want to feel like a celebrity, go to a conference with her because it's like, hi, hi. But I just really want to stress that to the board that we are taking it very seriously about not only do we want to use state tax credits in our lending and there, but we also want to see what else is out there. And so that's just been really exciting to be able to engage in those communities. That's all I have right now, and so I'll let Dr. White get us back to the agenda.
Thank you, Rebecca. We will move on to item number 4.
Can I just add real quick, I'm sorry, to your comments? I think it's really the right time for CalHFA to lean in with the difficulties happening at the federal level of funding, the high demand that the tax credit program sees. We need to be figuring out alternative funding structures, and so I'm really excited to hear the ideas coming from staff. It is generated by the staff and by you all, and it's really greatly appreciated. And I feel like we can lean in more. This is the time, and just this is really cool, very exciting.
I echo your sentiments. This is the time to start thinking outside of our traditional ways to finance. We can't abandon that, but we clearly can add more to the playbook when it comes to financing housing. Any comments on that from the board?
It's good news. Thank you.
Yeah. So we'll move on to item 4, report from our Audit and Risk Management Committee. Delilah Sotelo, Chair of the committee, will give us a report.
Great, thank you very much, Director White. The Audit and Risk Management Committee met earlier today, and as you know, we've expanded our role to include risk management. So at today's meeting, we heard from Kelly Madsen, who's the Director of Enterprise Risk and Enterprise Risk Management, and Special Initiatives. She provided the committee with really a comprehensive overview of the framework that we're going to be using moving forward when we're assessing risk. And really, it's an agency-wide effort that really starts here at the board with the idea that the framework will be a mantle that lays over all the work that CalHFA does. Really, as we look at outlining key activities, plan to support the evaluation of risk throughout the agency, and establish the pulls and levers that we need to kind of work through and ensure that the agency, is really protected going forward. And that not only includes internal risk, but those that we see from outside sources like the federal government and, other potential impacts in the industry. So I really want to thank Ms. Madsen and her team for putting together a very strong framework. It is available for the board to review. We're going to see it again in August. And at that point, we'll have probably a more robust discussion and presentation to the board so you can see what the details of the framework are. Ultimately, what we're trying to achieve is that we put together an evaluation that will help support the strategic plan that we engage with at the end of the year. So once we establish a framework to understand risk, then we'll incorporate that into our strategic planning efforts that will take us on for the next 3 years. So we're very excited about that. And I'm happy to entertain any questions on that if the board has. But right now, you'll probably hear more from us as we, develop with Kelly the framework. The next item was that we did get a presentation with our comptroller, Oksana, and as always, we're grateful for her transparency and for her engagement at the committee level. We went and evaluated through the RFQ for selecting an auditor. The criteria is strong criteria. It's very, robust in nature. We made sure that in the dialogue, we made room for small business enterprises and diverse firms that could also apply for the RFQ because that's an important element. So it's not just the big 5 firms, but really expanding our outreach efforts and ensuring that our criteria is strong enough to attract qualified firms to look at our audit. So we really appreciate Oksana listening to the committee's engagement at that level and the importance that we placed on making sure that we're just not looking at the typical process for selecting an auditor and then moving forward. So that RFQ is going to be made available online through conferences, I hope, and through the portal itself to bring in a response at the RFQ level and hopefully come back to the committee for the selection of the final auditor for our program. So we'll be seeing more of that, and I will certainly come back to the board and report back on our success for outreach as well as engagement. I just wanted to echo Rebecca's congratulations of the team, recognizing Oksana and Erwin's fiscal division for their amazing work at getting the annual comprehensive financial report awarded an 8th year. We challenged them to go for 10, so you're up to the task. But it's really a big deal, and we're very honored to have such a dynamic team and a team that's so recognized for the good work that they've done. So thank you for that, and I can never say enough to Oksana for her leadership of the division and her help, and Erwin's continued professionalism in bringing up the quality of the work. So thank you very much for that. If there are any questions, I'm happy to entertain them right now.
I have a comment and a question. So it was my first time attending as an audience member the audit committee meeting, and it was totally fascinating, to be quite honest. And I thought both presentations were really thoughtful and well done. I loved the approach around the risk management. I can't wait to see how that unfolds over time. The question, it comes back to what you had just raised, which is I heard a little bit about the qualification expectations of anyone who responds to the audit RFQ, but then there's also this commitment to trying to open up the doors to others, and I didn't know how that quite works together. I thought it was great, right? I feel like we in government tend to put barriers that stop people from being able to enter, vendors and developers, contractors, to enter into the system. So I loved the idea of being able to open it up more, but I thought that the requirements we're also going to stop that from happening. So it's kind of an interesting balance. So I don't know if that's a question as much of like, I just can't wait to see how that unfolds, and does it really open it up to new applicants or a broader field of applicants?
Yeah, no, I think that's a really helpful question.
I think, when the Ms. Glutenko was reading all these requirements, I was like, I don't even know if I know all of those words. And so it is something that we need to be able to, we really do need to have a qualified auditor. And at the end of the day, I think she said it best, which is we're looking for value. So, and I've learned in a past life with healthcare, as value is defined as quality plus cost. So we're not going to sacrifice quality for just the lowest cost and looking for that value. I will say, I think that as Ms. Sotelo knows, as a board member for CalHRC, we did have luck in finding a smaller firm. They actually work out of the state of New York, and they were very excited to be able to break into federally funded. They had experience doing housing. They'd worked with the New York State housing departments and stuff like that, but they actually had run so we did actually have a very successful recruitment for a smaller firm trying to kind of expand their scope of services. It wasn't one of the big fives, and we've had a very, very positive relationship with them. So we do take your comments very sincerely, Director Prince, but I think as Ms. Sotelo knows, as someone who's overseen both, we have had actually that success. California is a special place, and I think people recognize the opportunity to want to break into this market.
And thank you very much for that, Rebecca. As the chair of the committee, I think that's one of the things that we charged Oksana with, that it's not about changing the quality of the work and the requirements that we have for that work, because audit work is very specific in nature, and it's very important to create the fiscal parameters that we need to qualify for all the various awards that we go through. But I think that the critical point is the outreach, right? I think that people need to, in the industry, need to understand and know that we are open to receiving feedback and receiving responses from small firms and from firms of color, because I think part of the dynamic is that people don't know that we're open to it, right? So that they don't try. And so even if we ultimately don't select them, the fact that they've participated in an RFQ process with us will make it so that the door is now officially open with them. So I think that critical to the success, and I think Oksana and the team recognize this, is reaching out and expanding our coverage. And really being public about the fact that we're opening the doors to the various firms. So thank you for that. I appreciate that. Are there any other questions or comments on the work of the committee? Okay, with that, I'll turn it back to Director White. Thank you very much.
Thank you, Director Sotelo. Courtney, could we open this up for public comment?
Certainly, if any members of the public would like to make a comment, please come forward. Not seeing any.
Thank you. We will move to action item 5, which is a final loan commitment for Julian Street Studios. Director of Multifamily Programs, Stephanie McFadden, will give the presentation.
Good morning. Oh, great. Great to see you all. Steve Gallagher, my deputy, is not here today. He's at State Fair. His kids are showing swine right now. Right now. It's kind of awesome. Anyway, thank you. We have, as Dr. White said, we have 3 action items for you today. I'm going to start with Julian Street. You have a summary in your package, and then I think there's a little presentation slide too. Julian Street Studios is a new construction, mixed-income family development located in San Jose, Santa Clara County, that will be comprised of 305 residential units in a 7-story high-rise building. 301 units will have restricted rents in a typical range for us, which is between 30% AMI and 70% AMI. Total development cost per unit is $498,000. This project's going to use modular construction, which has helped a lot on the cost side. The developer is JSL Real Estate Corporation, who is an emerging developer and will partner with Corporation for Better Housing, who CalHFA has worked with before and meets our development team requirements. There are some energy efficiency design features incorporated in this design, and the construction lender is Bank of California. The development has been allocated $127 million in private activity bonds by SIDLAC, thank you, and expects to use $11.2 million in recycled bonds for the construction period. There will be $68 million in federal tax credits and $36 million of state tax credits through CalHFA's allocation. Today, we're requesting board approval of $44.9 million in first lien permanent financing and $4 million in MIP subordinate gap financing. The borrower will take fee ownership of the land at closing, and CalHFA loans will be secured against that fee interest. We have 2 exceptions that we are recommending for this project. The first is a result of a density bonus agreement from the City of San Jose. This will be recorded at construction loan closing and will remain senior to our deed of trust and restrictions, but also we will have our typical standstill agreement that preserves our restrictions. In addition, as we have seen regularly through this MIP 2024 round, the borrower is requesting that they receive more than 50% of the net cash flow, the surplus cash, This is to go towards repaying the deferred developer fee within a 15-year timeframe. This is a requirement of the tax credit investor to preserve basis in that deal. And that is our recommendation and presentation for this deal. Any questions?
Open it up for discussion on the board.
I think everyone knows that that exception is one that I don't like. There's an applicant who came through the MIP program that came from San Jose. We in the community did not allow them to exceed the 50% as the Housing Authority was providing a lot of vouchers and the city and county were providing dollars. I think that there are ways to address it, and I'm not going to vote no, but I just want to continue to ask that we look at that. I don't think it's appropriate to be giving them the higher percentage of the distribution of cash flow. That's just my personal feeling. I do think we have the money. We get to decide a little bit more. So I would like to see us push it a little bit more. But that's just my small little comment. And I'm glad that to see this project come into my community. So definitely going to vote for it.
Thank you.
Okay. Director Lamont?
Thank you. I just, in the context of just our affordability crisis and how many units we are mandated in the state to try to fill the gap, I just want to highlight the immense cost savings that the fact that it was modular had on this project. I remember previous projects that we approved were upwards of around $1 million per unit. This project is at around $454,000 a unit, which, in the context of serving as many Californians as we can, and anytime that we can do modular, I think this project really highlights the cost savings that we have for the state. So thank you.
Director Russell? Sure.
Yeah, thank you. And I would say, I feel like you buried the lead on this one because it was really the architect, the place where it said modular was in the experience of the architect. And this is something I think we should be celebrating because we are having to innovate if we're going to get our way out of this crisis. So just to note that I would have loved to have seen that as the first line of the project description.
Noted.
I would also say there is some cost containment language in there where you talk about typical strategies, getting 3 bids, and making sure that everything is bid out. In modular, are there actually 3 modular companies that we can bid that can bid against each other in the state of California?
I do not know the answer to that, but I believe there are 3. Nope.
Okay.
The developer's in the audience. He says no. So you're right, that is a challenge for modular.
Well, the couple challenges I'm aware of with modular, one is the supply chain. So there are some risks there,
Yeah.
but experience in the field obviously mitigates that. And then the pattern of draws is typically different as the construction. And do we have a structure in place to accommodate the unusual kind of lumpiness of modular?
We are not the construction lender, so we did not have to go through that kind of analysis as a prior construction lender. That is quite challenging indeed. But as permanent lender, we rely on the construction lender's expertise to structure that part.
And we're confident that they're, yep, very good. Again, I really appreciate it. I do have a question for there's a note there that there is no locality. The locality was either not asked or did not have an opinion on the project. And that was page 32, local support. And I just thought that was curious. I assume if it's a by right project that we move forward, and I actually, at the risk of saying something, we have by right development for a reason, and the reason is because we don't have to wait for localities, we don't have to overcome, So my question is this unusual that San Jose didn't support or oppose the project?
I actually, the developer is here, or Kevin. Kevin's going to come up here. And
Okay.
Thank you, Kevin Brown, our very experienced lender.
Hi there, I'm Kevin Brown, Housing Finance Officer for CalHFA. When we receive a project, we will send out a notice to the locality asking for them to provide their input on the project or the developer and their experiences with them in the past. Some localities respond, some do not. We do try to follow up, but we don't, try to turn the screws to them or anything to get them to respond. If they don't feel comfortable doing so, we respect that.
Okay. Well, and I respect very much, again, that we have laws that create by right development for a reason, and the very reason is to not allow obstreperousness to prevent this critical housing from being built. Thank you for that explanation.
Director.
Thank you. Great job. Eco modular and just the use of density bonus is a big win here. Any money from the city of San Jose in this project?
No.
So most of the money coming from this project is basically the HFA loan and tax credit.
Tax credit equity, yes.
And then you have 40 to 70 AMI, but I see that 178 units will be at 120. That still makes it's a little, I haven't done the math yet, but we're still at average below 70 if those many units are at 120?
Yeah, so the TCAC restrictions qualify for the 60% AMI average. The 120% AMI units are just the MIP restrictions. They're not the most restrictive. So those units will probably more likely be 70% units or a portion of 60% or 50% units in reality.
Right, so the ultimate restrictions are on 301 of the units, and that is between 30 and 70% AMI. That's what they will be set at. So the 120 is sort of like, doesn't affect it.
Yeah.
Right.
It's a catch-all that allows us to lend MIP on those other units.
Okay, thank you.
Chair White, this is where the MIP policy is always divergent from what the practice is, right? Because the MIP policy is such that we're trying to encourage 120% AMI units, but in the de facto reality of the financing is that they all end up being at 70% average income or below. And so we're really not getting 120% AMI units. So as a board, we either have to align the policy with the reality of what's being financed over the last history of the MIP, or we've got to align what's being funded with the objective of the policy, which is to encourage and to help fund projects that don't necessarily qualify for TCAC and CIDLAC funding, and that are higher at 110, 120% AMI. So, this is a discussion that as a board we have to take into consideration. So that's always my question, right? But there are no units here that are, in fact, at 120% AMI. They, from a regulatory standpoint, will not exceed 120% AMI for our MIP regulatory agreement, but they're de facto at 70% AMI. The page 19 of the presentation, page 8 of the staff report, you do a really good job, Stephanie, of outlining the developer fee issue, in understanding what the exception is that we're being asked to make on the developer fee. Are we being asked to allow for the TCAC allowed developer fee to be collected from cash flow? Or are we being asked to allow the full developer fee that doesn't have to be contributed back to the project, right? There's always a portion that has to get contributed back to the project. Are we allowing that full amount to be paid out before our loan? Is it the 6 million or is it the 12.4 million? I guess. Page 8. I guess I can look at the cash flow.
Yeah, we don't have the cash flow handy,
Oh, okay.
Unfortunately.
So just as when you bring forward the exceptions for this particular regulation, if you can make the notation that if it's, because if we're tying the exception to the investor's insistence that fee be collected for purposes of eligible basis, that qualifier is based on the amount that's allowable to be collected, not the general partner contribution that's required.
Right.
Right.
So I just want to I'm supportive of the exception, And again, we have to align the policy with what is de facto happening or change what is happening with the policy. But I just want to be clear that we're allowing them to only collect what's allowable under TCAC, CIDLAC for eligible basis purposes.
That is definitely our practice, is to follow the TCAC and CIDLAC requirements, yes.
Okay, great. Thank you.
I just want to go back to what Director Velasquez was sort of noting about kind of the AMI targeting, because this has come up as I'm trying to kind of streamline CIDLAC and TCAC, and you'll see on page 11 how like the restricted units for CIDLAC for the bond is different than for TCAC, and it creates a lot of, I think, confusion for folks, including myself, when I am like looking at a CIDLAC resolution and then comparing it to what the actual program requirements were or what the applicant committed to. And so I just think as we are working towards consolidation of efficiencies and consolidating compliance monitoring, we should really be looking at how to make this less confusing. And moving towards a system where there's like one regulatory agreement that kind of captures the true commitment of the developer, even if the minimum requirements of the bond program or the MIP guideline rules, et cetera, we're just looking at like what was the real commitment from the developer, typically at the TCAC level, and that's just sort of what we do. I think that would overall make everything sort of more streamlined as we are implementing AB 2006 as well.
It's a great idea. Love it.
Sure, go ahead.
One comment and a question. First on a comment, I want to echo previous comments around the modular aspect of the building, in that not only the cost savings, I think, and I want to know, that's my question is about that, but not only the cost savings, but the expedited delivery of projects and sort of most likely climate friendlier than normal construction. So I think those are things that we should continuously incentivize. We are at the Strategic Growth Council, for example, where we made housing as a climate policy priority and where we were focusing on new policies. One of them is around factory-built housing. So we're trying to create incentives for factory-built housing, such as modular units, for the reasons that I stated. Most costly, saves time, but it's also climate friendly. So anything we do, especially, the exception in this case is justified even by that, I think that's something that we should consider. My question has to do with, I think it was Noreen who said from $1 million, typically now $479,000 per unit. If the developer could actually answer, what do you anticipate the delta is as a result of the modular unit versus, all other costs? Is there a way that you can simply sort of tell us, is there a delta?
Please introduce yourself. Justin Hart. I work with Corporation for Better Housing, the managing general partner for this particular development. One of the reasons why we chose modular housing is the cost certainty. In construction costs, especially in high-cost areas, particularly in Northern California, we've seen costs escalate, especially over the last 4 to 5 years, due to supply chain issues, labor restriction issues. And so we've seen and in fact been part of that conversation and got significant change orders over the course of that period of time, because contractors will order up the supplies later down on the line. One of the benefits of the modular component is a more refined sense of what your costs are earlier on in the process. So, when we enter into a contract with our supplier, who's in this particular case out of California, we've already been spending the last literally a year planning the modular units, identifying who the vendors are going to be that they purchase it from. They also have a very big footprint with a supplier group and a logistical group to help utilize leverage in securing bulk pricing components. And so what that modular group will do is that they effectively will start production, let's say in 2 months for this particular deal. I don't know if that's exactly it, but roughly around then. And they will have the majority of those supplies on site because it's a manufacturer. It has to be there. So they have that price certainty, the timing certainty, and then the delivery certainty to the site. So all those factors add in. I don't have I can't quantify that for you specifically. I'm happy to, keep estimates and report back to staff on, basically a dummied up version if we did a traditional stick build and what we believe those costs would be versus what the true costs are. And we can continue to update staff and the committee as necessary as this trend is becoming a lot more popular and beneficial, we think, for costs in the state of California that are just ever increasing, whether it's construction costs, operational costs, and everything in between.
Thank you. I think that qualitative description is also important. So as we move along, I think it's be great to keep educating, obviously, decision makers, but the public as well in terms of those benefits. Thank you.
Happy to.
Thank you. Which factory is providing the modules?
We're working with Harbinger out of Mar Island.
Oh.
Chair White, just a quick comment. I think it's particularly impactful that this building is a 7-story building, right? So it's not only, typically we see the hard cost construction costs are approximately $245,000 per unit. Typically we see, high rises at north of $800,000 per unit. So, I think that, typically the project like we saw in Palmdale at the previous meeting or 2 meetings ago, that was because there was a big sprawl. So the type of construction was, 1 story, 2 story. This is 7 stories. So that's what makes it really unique. In modular, you don't have the challenges of steel beams and all that because you're basically stacking the units. So I'm not saying every building that we build now should be 7 stories, but this is really, it's impactful because of that.
Yeah, Director Russell.
I have a quick question. You mentioned the producer Harbinger at Mare Island, and are they related to, successor to Factory OS?
Yes. Yeah, the answer is yes. The Factory OS rebranded itself as Harbinger on Mar Island.
Oh, very good. Okay. Thank you.
Not that it affects the vote. I do think we need to come back and, Marina and I had this conversation a year ago about like local participation or the lack thereof and what does that mean? And I think that you're totally right. You raised the by right kind of issue. And then Gustavo, I think you're raising like, why isn't the local entity there? And I think that there is tension and conflicts that happen when the local comes in. And sometimes I think there are tensions when they're not in. So I just think it should be a topic for us down the road. I think we're doing a retreat-ish strategic planning in July. Maybe it could be part of that conversation.
Any other comments, questions? We're encouraged by that low cost, by the way, if you can't hear that. Courtney, any public comments?
If any members of the public would like to make a comment, please come forward. None at this time.
Thank you. So item number 6, Stephanie, I think this is.
Do you want to vote
I'm
to
sorry.
approve?
I'm ready to go.
Please.
All right, so we got a motion from Preston to approve. Item number
Second.
5.
Okay, I'll
Thank
call
you.
the roll. Undersecretary Grant,
Yes.
Ms. Limon,
Yes.
Ms. Wyatt,
Yes. Thank you.
Mr. Prince,
Thank you so much.
Mr. Russell,
Aye.
Mr. Fiegels,
Yes.
Ms. Sotelo,
Yes.
Director Velasquez,
Yes.
Dr. White,
Yes.
and Mr. Williams.
Yes.
Resolution 25-14 is approved.
Thank you. Now we'll move on.
Yes, great. Thank you.
Item 6.
This project is going to sound Very familiar. There are a lot of commonalities with the one that we just talked about. Vera Avenue Apartments is a new construction, mixed-income family development located in Redwood City, San Mateo County. There will be 178 residential units, again in a 7-story high-rise. Of the 178 units, 176 will have rents restricted between 30 and 70% of AMI. In this case, the total development cost is about $581,000 per unit. The developer here is Summix, who is an emerging developer and will partner with Corporation for Better Housing. You just heard from Justin. Again, the design includes energy efficiency features, and it's a similar deal team. The construction lender is Bank of California. The project has been allocated $85 million in private activity bonds and expects to use $8 million of recycled bonds during the construction period. There will be $47 million in federal tax credits and $24 million in state tax credits through our CalHFA set-aside. Today, we're requesting approval of a $28.5 million permanent loan and a $4 million MIP subordinate gap loan. Again, the borrower will take fee ownership of the land at closing, and our loan will be secured by that land and improvements. The same 2 exceptions are recommended for this deal. There is a density bonus agreement recorded ahead of our restrictions, but we will require a standstill agreement to be executed as well. And similarly, in this case, the developer has requested 100% of surplus cash to go towards the deferred developer fee to preserve eligible basis within the TCAC limits of the developer fee. Any questions on this deal?
Director Russell.
So you said it's similar to the last one, but not in being modular.
It is also modular, excuse me.
Okay,
Yes, it is
okay.
also modular.
Thank you, because I saw this 578.
I just,
per
as
unit.
I finished, I was like, I think I forgot to say that.
I didn't pick it up in the report, but it's a lot there. And I did want to mention that I appreciate the developer working with an emerging developer. I think the 2 cases here
Yep.
today, it's the way the model is supposed to work.
Yep.
Is this kind of mentorship. And then I had a question. I was just curious about the site. Was that just anomalous that there's this half-built project there? I mean, or why is there a site sitting there with 5 half-completed buildings?
I'll ask Justin to give you that story, which I'm sure is very interesting.
Well, and I'm more interested in whether this is an absolutely unique circumstance, or is this something we should be looking for?
Yeah, Justin Hart with Summix LLC. We found when the site was brought to us, it was actually in conservatorship, or is currently in conservatorship. And so it's been in the family for quite a while. They tried to rebuild it and ran out of cash. And so it's been sitting there vacant. One of our strategies for a period of time, though, was to actually target these smaller site infill locations. This is approximately 0.6, and it's part of the downtown specific plan within Redwood City. It's an incredible site. We're very fortunate to have identified that site and more fortunate to have secured the necessary financing to build 178 units. But it's right across the street from downtown, right down the street from Mark Zuckerberg's innovation development. Elko Yards is a significant multi-billion dollar development right there. It's right near the SMART train. It's very lucky, but to your question, it's under conservatorship. So we were able to strike a deal with the landowner and, bring the housing to that site.
Great. Well, I think the affordable housing sector has just always shown itself to be nimble, creative, finding opportunities where the market may not see them, and so I appreciate the role that you're playing in that. Thank you.
Any additional questions from the board?
I have a question regarding modular. Who is the company that's actually constructing the units?
I would expect it would be Harbinger at Mare Island, as in the prior deal.
All right.
Yep.
Thank you.
Any additional questions? Not as low as the last deal, but still below 600,000. And it's 7 stories. So,
I'm sorry, Stephen put it in my head. Can you talk about what is the ownership structure of the emerging partner? I mean, kind of curious, who makes up that ownership, or who makes up that entity of Summix?
Summix? Okay, here's Justin, to give you a little detail.
Summix is an entity, is my entity. I partnered up with Corporation for Better Housing with a direct interest.
Okay, and you have not had past history with the
I've
public-
never had an ownership interest in any of the developments before, so I was given the opportunity, saw it, very excited about that.
Great, thank you.
That's great. Thank you.
any additional questions from the board? Courtney, can you open up for public comment?
Any members of the public would like to make a comment, please come forward. None at this time.
I'll entertain a motion to approve.
So
Move that we,
No, I can yield.
I move that we approve.
Thank you. Thank you, Director Williams.
A second.
Thank you.
Undersecretary Grant,
Yes.
Ms. Lamone,
Yes.
Ms. Wyatt,
Yes.
Mr. Prince, Mr. Russell,
Aye.
Mr. Fiegels, Ms. Sotelo,
I'm going to abstain on this one.
Director Velasquez,
Yes.
Dr. White,
Yes.
and Mr. Williams.
Yes.
Resolution 25-15 is approved.
Thank you. We will move to item 7, and I believe Director Russell needs to.
Yes, thank you, Dr. White. So I will be recusing myself, as is my practice. USA Properties is a member of the San Diego Housing Federation, and to avoid even the appearance of any conflict, I will leave the room.
Thank you.
Okay, great. Okay for me to start? Yeah?
Floor is
Okay. Chris says it's okay. I think we have another little slide on this deal, too. Terracina at the Dunes is a new construction, 142-unit project across 2 sites. It's a family project that was awarded under the 2021 MIP program. This project is located in Marina, which is in Monterey County, and the developer, as you just heard, is USA Properties. The construction lender is JP Morgan Chase, and the investor is WNC and Associates. In April of 2022, CalHFA committed to providing a $17.5 million perm loan and a $2.8 million MIP subsidy loan. A little over a month later, CalHFA amended its commitment to increase the permanent loan amount to $18.8 million. Construction and lease-up are complete. The project is 100% leased, and in May reached its 90-day performance period. The project, however, has experienced impacts related to being built during the COVID-19 pandemic. These impacts resulted in timing delays, cost inflation, and material and workforce shortages. Most impactful, perhaps, was the construction loan variable interest rate, which was underwritten at 1.95% and ended up being more like 6.7%. The overall increase to total development costs was approximately $3.5 million. To help mitigate these budget shortages at Permanent, the developer is requesting a $3.7 million increase to the permanent loan commitment amount for a total of $21.25 million. This is a 21% increase and requires board approval. The updated appraisal and underwriting support this increase. To help cover the remaining cost increases, the developer has increased their deferred developer fee and will be eligible for additional tax credit equity at 8609. CalHFA will be applying a slightly higher interest rate for this increase, and the The developer is targeting to close the permanent financing before the end of June, which is within the current closing deadline of August 30th. Any questions on this? I'll note that for projects of this vintage, we are seeing these kinds of cost increases kind of across the board. And we understand USA Properties is seeing that also across their projects that were built during this time frame. So I know you have already seen a couple of these permanent loan increases, and you may continue to do so as these projects reach permanent conversion.
Okay. Director Williams, you have a question?
You mentioned that there would be a slight interest rate increase.
Yeah.
So it would go from what to the new interest
So
rate?
the overall rate will be 5.76%, and this is a 0.23% increase from the original rate lock at construction closing.
Thank you.
Any other questions from the board?
I move approval.
Have a second?
I'll second.
Oh, I thought you said you second, but, okay.
No. Courtney, can you?
Sure. Undersecretary Grant,
Yes.
Ms. Limon,
Yes.
Ms. Wyatt,
Yes.
Mr. Prince, Mr. Fegels,
Yes.
Ms. Sotelo,
Yes.
Director Velasquez,
Yes.
Dr. White,
Yes.
and Mr. Williams.
Yes.
Resolution 25-16 is approved.
Thank you, Stephanie.
Thank you all.
We will move on to item number 8. It's a capital markets update and homeownership revenue bond summary update. Erwin Tam, Albert Luong.
All right. Good morning. Erwin Tam, Director of Financing, here to give you a capital markets update. It's actually a 2-for-1 presentation today, capital markets and a bond summary report from the agency's first issuance of bonds financing its single-family programs since 2011. So, but first, before we get to the good news is, not the right slide. There we are. As a little bit of a recap of what has happened over the past couple of weeks. Since we last met in March, the capital markets have been incredibly volatile. And I just wanted to alert the board that the volatility has a direct, and maybe not immediate impact, but definitely a direct impact on both its single-family and multifamily lending programs. So when we think about the outlook of the agency's financial future, the agency will face some headwinds in the next couple of months and perhaps even a couple of years based on what has happened. Next page, please. As you may know, on Friday, the federal government, the U.S. sovereign rating was downgraded by Moody's Investors Service from its AAA rating to AA1. The impact on the agency has been a downgrade of its homeowner mortgage revenue bonds, the ones we just issued in March, from AAA to AA1, and its multifamily housing revenue bonds from that it has issued in 2016. Today, the agency just posted its EMMA notices as required underneath its continuing disclosure obligations. This is not a reflection of any action by the agency proper. 31 HFAs and other multifamily and single-family bond issuers in the housing space were also downgraded as well. So again, this is separate and apart from any activity and is not a reflection of the agency itself, the financial wherewithal and the strength we've all collectively built together here. One of the other things that has happened, and this is actually already out of date, the budget reconciliation bill moved forward overnight in the House of Representatives. One of the things that we had been monitoring is the effect on tax-exempt bonds, which have not been affected, nor have private activity bonds. And that actually is some decent news, but there is uncertainty in the U.S. Senate. And so I think that the road is still pretty long in terms of it has to go Senate and then conference committee thereafter. But as of right now, both private activity bonds and tax exemption are still within are still allowed within the legislation. So let's talk a little bit about. Sorry, I'll stop for any questions. I know I just went through a lot of information very quickly. But so I'm just going to pause here just to see if you have any questions instead of saving it for the end from any of the members of the board.
Thank you so much, Director Tam. My question is on, just given the volatility of the market, are we adjusting our issuance strategy to mitigate risk?
That's actually a good question. And maybe I'm going to talk about that in context of both the single and multifamily programs on the next two slides. So that's a great segue. And it's sort of the impact as to how we think about rates and how we set rates in both single and multifamily lending, and then how do we issue, to your point, how do we issue bonds and finance those loans we're putting that borrowers are looking for us to finance. Do we have any other questions before I move on? So on the next page for single family programs, one of the things about single family programs is we set mortgage rates on a daily basis. So the downgrade really doesn't have, and I will say this, coming off the last slide, the downgrade really did not have a direct impact because it was sort of expected. Moody's had the US government on negative outlook for a very long while. Both Standard & Poor's and Fitch Ratings also rated the government at that lower level, the second highest rating, but not at the AAA level. So the downgrade from Moody's didn't really have that immediate impact that one would think because it had sort of been baked into the market itself. Treasuries also have moved. However, Treasuries, what the action did do, however, was remind investors that the U.S. economy and budget deficits matter. And so when we look at the bills that are, the budget bill, the reconciliation bill that's in the House of Representatives and moving to the Senate, plus the ongoing budget bill that's happening in the fall for the next fiscal year, it's called additional attention to that. And so you've seen interest rates rise significantly in both the taxable and tax-exempt side. And that does affect, again, the loan rates we post on a daily basis, as well as our bond executions. On the single-family side, we're still looking for, so we typically finance our loans through the TBA market. So those, again, that adjusts every day, and we deliver into the TBA execution. On the bond side, however, for the My Access program, that is, we basically price bonds, and we're looking to price bonds every, let's say, 4 to 8 times a year in terms of accessing the capital markets, and this will have an impact depending on the Treasury spreads there. However, the financing strategy is very different for single family. What we're doing is we are allowing reservations into our My Access program, and then every week we will hedge the execution. So essentially, we are taking that risk of the agency off the table and then picking a date certain which we will issue bonds on. So we will take reservations, hedge, and then issue bonds, and it'll just kind of continue like clockwork, irrespective of the market in theory, because we have those hedges that we were putting onto it. This board has adopted just as a reminder, this board has adopted a financial risk management policy, which allows us to hedge and has us establish a hedge reserve, as well as allows us for the first time to hedge our single family bond issuance as well, to make sure that again, that the agency itself is not taking market risk on its loan reservations for its single family programs.
But does the hedging strategy depend on how many reservations you receive?
Exactly.
Okay.
So yeah, exactly. So we don't do anticipatory hedges. What we're going to do is essentially look at how many reservations we have in any given week, and then hedge those. Hedge with, obviously there's some fallout, but hedge those to the delivery of the security. So we've thought a lot about it. It's kind of a novel approach, I think, amongst HFAs. Most HFAs would actually, my belief is that most HFAs would actually just issue bonds sort of halfway through their cycle And so what you would do is have 50 million, let's say if you had a $100 million pipeline, you'd issue bonds halfway through the 100 million. So you take market risk on the following 50 million based on, just based on the prevailing rates at that time. So, HFAs would just sit on the bond proceeds and then kind of dole those out based on loan reservations thereafter. So I think our strategy is to take as much risk off the table for the agency in this very volatile market environment. One of the final takeaways on this page is when we look forward. So what happens next to CalHFA in terms of its single-family productions? And the chart to the right shows home prices in California. It's the home price index versus rates. And what you kind of see here is that as rates sharply rose in 2022 and 2023, there actually was a slowdown in price appreciation. That has since changed, right? I think the housing market has accepted high interest rates as the new normal. So we've continued to see appreciation in sort of that 4.5% range, which is close to the historical average. Based on appreciation and rates, however, and sort of the uncertain market, the macroeconomic environment, there's a lot of uncertainty as to whether or not this housing market is going to continue to move forward at this level of price appreciation over the next couple of years. So again, when we think about how it affects the agency, single-family volume could potentially be challenged based on the high rates and higher home prices in California. Moving on to our capital markets and multifamily programs, I will note that we just posted our official statement for our bond issuance for the Affordable Housing Revenue Bonds, Series 2025A. This will finance 5 multifamily loans that we have since converted to PERM. CalHFA is an on-balance sheet lender for its multifamily programs, and it works in a little bit different way. The board just approved final commitments, and essentially what we are telling our borrowers is, hey, when you guys convert to PERM in 3 or hopefully closer to 3, but 3 to 4 years during construction, we'll be there. We will deliver you the proceeds at this rate certain in this date in the future. So CalHFA itself takes on interest rate risk for the next 3 years. And we've entered into we've again, based on the revised financial risk management policy, the agency has entered into hedges in anticipation of changes in interest rates on these multifamily loan production. One of the things we don't hedge for, and this is actually really kind of important though, is the value of tax exemption. And if you could see here, this is a chart from the last meeting of the board from March 19, and it goes through last Friday. The blue line is the tax exempt rate. And you can see there was this one day where the value of tax exemption was nothing, essentially. Like a 30-year MMD, a tax exempt bond, represented by the blue line, was higher in yield than a taxable bond, which actually has a very negative effect for the agency and sort of its customers, right? We think of our ability to issue tax exempt bonds as our superpower, and our superpower for at least a very short period of time became very worthless. And so we're constantly trying to monitor the value of tax exemption. That is not what that is something we cannot hedge for, right? It is something that is tax risk and policy risk at the federal level is something we hedge for higher interest rates, but we don't hedge for changes in taxes. And so I want to just point that out for the members of the board here. The way it works is if credit spreads and interest rates trend higher, our borrowers will eventually see that through a reset in terms of our spreads that we have on our multifamily loans. So it's not immediate. So if this happens, like I said, we are good to deliver the rates we promise to our borrowers. These are big financial promises, and that's why we come to the board and go to the board and say, hey, it's not just does the board want to lend whatever $30 million for this development? It's actually the question I think to the board is, does the board want to lend $30 million at this stated interest rate to the development? And that's really the key, again, because we're making a financial promise on dollars and interest rate to any borrower that comes in front of this board. And so again, the way we would adjust is on future commitments, that there may be a higher spread depending on what we see. We look every year, we make an adjustment based on our actual credit spreads, and we will adjust pricing thereafter again to our potential borrowers on the multifamily developments. Does anybody have, I think that's pretty much summarized my presentation here. Does anybody have any questions on the multifamily question?
Questions from
Sorry,
the board?
Director Prince, sorry, excuse me.
Go ahead. Go ahead, Director Sotelo.
Just stay on that point on the spread. You're not exercising the spread on the commitments that we've made, but just the future commitments that we're making at whatever given time.
Correct, yes.
Okay, so
Like
you're adjusting and looking at it.
Yes.
So that is that is a wonderful function that we have here at the agency, that we're able to look at it real time, adjust those spreads based on past and then future anticipated rates. So I think that's fantastic. And the fact that we are able to do forward commitments, not only on amount, but on rate, that's very attractive to the developer community. And that really is our superpower right there. It's not necessarily the tax exempt nature, but the superpower being able to market and have Stephanie be able to market that forward commitment and that set. I think that predictability with developers is huge. So thank you.
Yeah, Director Prince.
Yeah, I just want to say, I've been here again 11 years, and I thought that was like one of the best little presentations I just heard, right? And it made sense, and so maybe I just have to hear it over and over and finally sinks in. I love seeing the Krypton, right? The kryptonite that happened one day, or that's just fascinating to think about how that happens. I definitely, you made me very nervous to think about us making commitments 3 or 4 years down the road, particularly in today's volatile kind of environment at the federal level and just what's going to happen. So I appreciate the review that you and others are always doing to make sure that we're not getting financially into trouble, right? So my question really goes back to, for those entities that get the forward commitment and the market is very different down the road, have we ever thought about sharing some of the successful hedge back to the developer? Particularly, I think about the one development in San Jose that had a very high interest rate. It's 100% PSH, could benefit from a little bit of a break. And I get it that they signed up for a commitment at that time when they closed, and then they converted to the perm 3 years later. But have we ever thought about trying to share some of that benefit to the?
I think we make this financial promise in good times and in bad times, and so we're good for it. And a lot of times it has been adverse, right? So you saw.
Well, that was the question I had. Is like, do you have a historical kind of like what has been the historical success or lack of success, the adverse or not adverse?
So actually, it's interesting because what we see here is a lot of loans. So prior to 2020, the agencies did not engage in a lot of perm lending business. So a lot of the loans you see here today were originated in 2020 to 2021. Rates at that time were in the threes. We were issuing perm loan commitments in the 3% range. In fact, my first board meeting, the agency did commit to a $70 million loan at 349, of which we are financing in this bond. So.
And what's the interest rate in this bond?
It's to be priced, but it's definitely north of 349. But the agency is good for it, right? We're not making an adjustment to that rate. What we're saying is our promises are good in good times and in bad, and we guarantee that rate. So I appreciate, I think that's an interesting notion, but I think that the developers community would benefit, or actually the stability of just knowing that this is the set price and it will not waver up or down based on external situations. That's the certainty that the agency is offering to our developers.
And I remember back in my day at a previous agency in the Valley, that there were CalHFA loans that were at really high interest rates. And then CalHFA was able to refinance and internally got a much lower interest rate. I have to say it created a lot of bad blood about trying to refinance that property with CalHFA, right, where there was a rate lock-in and all kinds of harm. And the interest rate, I seem to remember, was very high. And so I think that at some level, I get it, that the risk is happening and that there are adverse situations for CalHFA, and therefore that has to even out for the whole program. But I do think there should be some consideration about that relationship with the development partners. Again, just something to consider, not asking for.
Understood.
Thank you. Other questions from the board?
I'm going to turn it over to Albert now, if with the chair's permission. So we have a good story to tell. Again, launching a new bond program, financing a new single-family program, and it's kind of tough sometimes when you sit in the financing seat. We're just focused really on the numbers, and we don't realize we're standing up a completely new program to help low and moderate income Californians, first-time home buyers in California. So I'll turn it over to Albert to kind of walk you through the bond issuance and the successful sale.
Thank you, Erwin, and thank you for CalHFA. It's always a pleasure to be out here. The weather here is always better than New York, I'll tell you that much. So I always appreciate that. The traffic, though, is about the same. Maybe a little bit worse here. But as Erwin was mentioning, we have actually worked on this single-family indenture probably since the inception in 2022. So, call it 3 years in the making to get to the point of actually drafting the documents, figuring out the right accounts, creating the right structure. The structure evolved actually over time in the last 3 years. And, finally create also a single-family program, which is, as we now coined it, My Access, so that there was the right product to marry with the bond program to make, the economics work for the agency and to create a sustained annuitized income stream that, the HFA or CalHFA, that hasn't been able to really achieve through the single-family TBA program. So, a couple of highlights that we did this deal in March, so about 2 months ago. It was the inaugural transaction, and as Erwin mentioned, this is the first real new money transaction that CalHFA has done since 2011, so basically 15 years ago at this point. It was a very good transaction, had very good reception. So, a couple of highlights here is that, again, $50 million of first mortgage financing, about, call it $1.5 million or so of My Access funds funded through the bond program. We had 13 different accounts participate in this transaction. So one of the things that is different between taxable and tax-exempt bonds is that in tax-exempt bonds and through some of your probably case studies or recaps on the multifamily side is that there's tremendous amount of retail participation on tax-exempt bonds. That is not exactly the case in taxable. It's a completely different buyer base, truthfully. There are some retail and SMA or separately managed accounts, professional retail, but mainly it's driven by institutional investors and insurance funds. So, in this transaction, we had 13 investors, which is pretty good, given that's $50 million. We did a successful marketing of the transaction through a roadshow, similar to the multifamily transactions that have been done in the past. Had many one-on-one calls with investors about it. I think that the biggest question or two questions that most investors had were, one, CalHFA is issuing bonds again, and then two, why is it only $50 million? Isn't the state bigger than that? So we're like, this is the first of many deals to come, and it's just for CalHFA to kind of prime the engine for future production. And so I think that was, but again, many investors actually looked at this deal because they were very shocked and that CalHFA is back in the market after basically being dormant for almost 20 years. I guess the other highlight would be that, again, there about 2x oversubscription, meaning that there are almost $90 million of orders relative to $50 million of bonds. The PAC, which is a planned amortization class bond, it's a bond that's sort of a key driver of the cost of funds for single-family deals and something that's not in multifamily deals. And that is a bond that really attracts institutional demand. And that bond in particular here, the credit spread was plus 98, but we were able to tighten or lower the credit spread to 96, which is 2 basis points, which is kind of demonstrating the demand for that particular bond structure. And then the overall yield was a 5.50. So to put that in perspective to mortgage rates, this is sort of back of the envelope. But if your cost of capital is 5.50, you're trying to obviously lend higher than that. So let's say your mortgage rate is 650. So what CalHFA can now do is effectively earn 1 point, 650 minus 550 over the period of time on this bond deal. And that's where you create your annuitized income stream, right? Something that, again, you're not able to capture in TBA. And since you also service your own mortgages, you don't get that annuitized income from that perspective as well. Before I move off this page, I know it's a little technical, so are any questions on this, or?
I have a question. You said that we issued 50, but the demand was oversubscribed to 90. Given that fact, what is our ability to issue the next series and be able to take advantage of that strong interest now as opposed to what it may be in the future, given the volatility of the markets?
Do you want to answer that a little bit?
Sure.
first?
Think that's a great question, Director Williams. I think that our strategy, again, has been to reserve and then hedge. So irrespective of the current volatility in the market, that we're sort of aligning it with our just date certain that we will approach the financial markets rather than trying to time it based on sort of the current events. And we're using treasury hedges essentially to bridge the gap. So let's say we go out every, let's say we go out in 12 weeks time. So let's say we just issued bonds and I want to issue bonds 3 months from now. On week 1, we will issue a 12-week hedge. Week 2, we'll issue an 11-week hedge, and so on and so forth. So we just pick a date certain. And so the volatility, in theory, because we're hedging the underlying treasury rates, would actually not affect the agency. And so we'll go all the way to, I guess in theory, the last week we will not hedge production that week. But generally speaking, we feel very confident that the agency will be able to access the capital markets at any point in time and still have the same economics regardless of the underlying demand. I think the other question you were asking is, what happens with the oversubscription of in that deal? I think Albert referred to the adjustment lower in yield on the PAC bond, and that's what happens is that if you're oversubscribed in any maturity in a transaction, you're able to reduce the interest rates on that maturity depending on what the overall number of people who want that security are. So let's say if you have 10 people interested in it, so you're 10 times oversubscribed, clearly you can lower yields more. But if you had 2 people, it's a little tighter, right? There's a lot less wiggle room to have. So we have made those adjustments within this deal, and I think Albert's going to talk about sort of the details behind that pricing in a little later in this presentation.
All right, thank you.
And just to follow up on that point, in terms of sizing, we would also never, let's say, increase the size of the transaction to match the demand. The supply technically drives demand in this instance where, CalHFA can only originate so many mortgages per week or per month. So, if let's say this particular $50 million was 1 month's production, that's kind of it. And we can't just double the size of the deal based on the demand being there. It's sort of a function of how much is coming through the pipeline, and then we sort of size the deal based on that front.
All right, thank you.
One quick question, Albert, before you continue. What's the overall yield on this deal to the institutional investors?
It would be this. Their overall yield would be.
It is the
550. I mean, assuming if the institutional investor bought the entire bond series across all maturities, they would get 550.
In this what year was this again?
Sorry?
What year was this?
This is the deal that we just did in March.
This is the 2025, okay.
That's right. So the cost of capital or the overall bond yield on this transaction is, I'll call it, specifically a 548. I just rounded 550. But that's what the investor will receive if they actually bought the entire bond in every single maturity. Right? Because some investors can buy the shorter end of the bond transaction, some investors can buy the longer end of the transaction, so the yields will be a little bit different. But the average cost of capital across the entire deal is 550.
Got it. Okay, thank you. Director.
First of all, I think it warrants another celebration that CalHFA is issuing single-family bonds. So just wanted to congratulate us for doing this. And this might be a question for Director Ellen Martin, but Acting Director Franklin talked about, some of the distribution of where these loans were issued in kind of the heartland of California. But can we have a report on like what the loan to value ratio are for some of these loans, like what the price points are? Just be really interesting to see who are the takers.
Yes, and this was brought up, there was additional data points requested for the outcomes of the My Access program. We just need a little bit more time through the loan process, right? Reservations are not securitized necessarily. So before we come back to the board with those outcomes, but we'll certainly note those factors as well. We are planning on having a more deep dive of what the profile is of the people who have taken up this offer. But we need a little bit more time for kind of the actualization of the reservations to fully form. And then we need actual, kind of securitized loan information for able to provide that. So having just launched in mid-March, we're a little too soon on that end, but we are noting all of the different requests of the way we can slice the data for the board.
Thank you.
I agree, and I think that part of it is when we think of the single-family volume, $50 million of reservations versus the $2 billion plus that we typically, a volume we typically do every year, we want it to be a meaningful number. So I'm going to put words in everybody else's mouth here since I have the microphone. But we want to have a meaningful conversation as to the outcomes rather than some preliminary set of reservations that are in the pipeline before we come back to the board.
Just on the next page, I apologize, it's a little small. It's just a lot of numbers. But, just to provide a little bit of context of your competition, I suppose, friendly competition relative to your peers, Utah Housing and Mass Housing also priced the same day that week when CalHFA was pricing. And you'll see what's most important or the takeaways of this particular slide is just the green numbers. And that is the credit spread difference between CalHFA's bonds versus Utah and versus Massachusetts. So in other words, your credit spreads were lower in spread relative to Mass and Utah. And what that means is you're technically paying a lower rate based on the fact you have a lower credit spread. And so I think that kind of demonstrates CalHFA, one, it's the first time they've been back in the market. And so there's investor curiosity and demand to buy some Cal paper since they haven't been able to get exposure to California before. And then two, although this was AAA when we did this deal, I think investors don't really weigh on the rating as much as the collateral. And the collateral here is effectively mortgage-backed securities. And that's sort of the evolution of the HFA space from, call it pre-financial crisis to post-financial crisis, that many HFAs have transitioned over to mortgage-backed security indentures, and which are then used to issue bonds. And so people are able to recognize that CalHFA's AAA rate is not really based on AAA, it's based on the MBS collateral, and they're willing to pay up for that. Mass Housing in Utah, they both do MBS, but they also have significant amount of legacy whole loans in their indentures because those indentures have been ongoing for the last 30, 40 years at this point. And so there's a little bit of, I won't call it a penalty, but the investors are going to have some differentiation in pricing, especially if they're all pricing the same day, which these were, or at least Utah and California were. They're going to potentially pick, let's say California over Utah, given the same nature, which is they're both housing, but one has 100% mortgage-backed securities backing this bond versus, call it 90% in Utah, because Utah, still has whole loans from the past kind of mixed into this pot.
Okay. We're the best. And now Claire will read you a disclaimer based on my statement, please.
It's
our other superpower.
Any additional comments from the board? Yeah. Thank you both. Appreciate the presentation.
Oh, a couple
Oh, you
more
still have
pages.
more.
Yeah, yeah. Wait, there's
Erwin,
more.
you waited. Erwin, you gotta do this at the
Oh,
end.
I was still too soon.
Yeah, you were too soon.
The next page just gives you a little bit of contextual color of the week of March 10th and what else was pricing on single-family mortgage revenue bonds, as well as just California paper. I think generally what you're seeing now every week really is that even from January up to March and even post-March, there is a lot of taxable paper coming to the market from HFAs. It's not surprising anymore that you might see $150 to $200 million of taxable paper coming in from HFA, and mainly driven by two things. Either they're shorted on volume cap, so they need to finance balance their production using taxable bonds, or they're financing non-qualified or non-tax eligible loans with taxable bonds. And that's the instance with California, which is very unique in the sense that there's, at least working at RBC, there are no clients that we are aware of that actually just have a fully taxable program financing non-qualified mortgages. And I think that's just the nature of this state where all the volume cap is being dedicated to really dedicated to multifamily. So by that nature, CalHFA is issuing only taxable bonds, financing only non-qualified mortgages. And then on the California calendar, as again, a little unique here is that there's not a lot of taxable California paper as well, and a lot of this was just school districts. There was one, I think, California GO bond that was taxable. Maybe it was like 300 million or so. That was going to price the same week as this transaction, but actually was delayed a week. So we actually tried to not price it on the same day as that GO deal, although generally they're not, the investors are not the same. But even then, we don't want a housing investor to make an excuse saying that like the Cal GO deal didn't do well, so therefore this CalHFA deal shouldn't do well either. So we don't want to have one deal competing against the other. I'll make this quick, but the social bond framework. So given this was the first deal for CalHFA on the single family side, we also want to make sure that it was ESG labeled through the social bond framework. So RBC and CalHFA created the framework for this inaugural transaction. And so we actually did get one ESG order on this deal, $1 million, which was still pretty unique given that it's a taxable transaction. I think typically you don't really see that in the taxable investor space, but we were still able to garner at least one order for a truly ESG designated order for this transaction. So again, I think the framework helps, and having the S&P secondary party opinion, which represents SPO, does help provide investors some comfort if they're looking for that angle to purchase these bonds.
Where was that ESG investor based? Are they out of California or?
I will have to double check. I think it might have been national, but I can follow up with that.
Interesting.
And then this is kind of dovetailing a little bit to what Erwin was saying earlier. I think the 25A deal priced at a good time. Rates were sort of rallying as the year went on. And this graph kind of shows from the last Fed cut to the day we priced the deal, rates generally were coming down. So obviously you're benefiting from a lower treasury rate because the taxable bonds are benched off treasuries. But since then, since Liberation Day and then the pause of Liberation Day or tariffs, treasury rates haven't really recovered since then. And actually, now exacerbated higher given the deficit bill that's kind of been floating around. For example, on the top right corner of your page, we have the 5-year, 10-year, and 30-year treasuries as of May 19th. As of today, 5-year treasuries at 410, 10-year treasuries at 456, call it 10 basis points higher, and the 30-year is at 510. So, over 5%. And obviously, a lot of the concerns are just deficit spending and that are there going to be enough investors to buy treasury paper? I think there will be, but their calculus or the risk-adjusted return required to buy treasuries has now increased. And so you're seeing that pressure on treasuries, and that obviously reverberates in the taxable markets. And what Erwin was saying about putting treasury hedges, that is beneficial, right? You can't predict these type of movements, and having hedges as rates are rising will also provide a counterbalance to the higher interest rate costs. And that logic is similar to multifamily, and this is for single family, and I think that's a fantastic way. I mean, we can't hedge credit spreads, but at least hedging treasury rates and tweets is something that is a good initiative for CalHFA, especially since again we're only doing taxable bonds in the single family space. Just opening the floor of any other follow-up questions.
Any questions from the board?
My question isn't on this, Chair White. It's more, I guess, for the board a little globally. The single-family product, congratulations. We haven't been out for such a long time, so it's really great to see. What I'm wondering is, these are for single-family homes for individual mortgage borrowers. Is there potentially a product that we can put together for home builders, so that we can loan to home builders and set the rate and set the kind of the takeout financing for the home building activities, and use a similar mechanism to do that? Is that something that we can explore or have explored?
I'll comment on this particular structure, which is a mortgage-backed security structure. And I think the answer there is no, not underneath this current structure. This is essentially what we're taking is Ginnies and Fannies and putting it into this indenture. So that hence why when I went through the preamble about the U.S. federal government being downgraded, that they're providing the insurance to allow us to issue at these rates.
Right.
Whether or not, I think there's a separate question that, within there, which is, can the agency do something outside of this indenture? And I think that's a question, I think, more for what we're allowed to do under statute. And then sort of it's like what we're allowed to do, and then times, can we offer a market competitive product, even if we can do something, sometimes, depending on what it is, like I said, I'm trying to get back to what our superpowers are. If our superpowers can't help that situation, then maybe, and some other private lender can, and is already in that space, maybe it's something we don't do. Again, because we won't be additive to that market. So that's sort of my 2 cents as to what, to what you're getting at, that in terms of like a new product.
Yeah, I guess what I'm saying, and I'm not explaining it very well, is the idea that we would do a bond issuance or support for construction loan to a developer, a home builder, who would build whatever they need to build, but the backup and the takeout of that construction mechanism would be this mortgage-backed security instrument. So that it would eventually, individual home buyers would use this product, but it's directed at the homes that are built with our construction bond.
So I think that the agency on its multifamily and single-family programs does not offer a construction loan.
Right.
So I think the takeout is essentially what we do in both cases, right?
Yeah.
We, for when we think about our permanent loan lending for multifamily, essentially is to take out the construction loan. And similarly on the single-family side, what we're offering is, again, a mortgage for somebody to purchase a residence that's already constructed.
Right.
So it's not within our current parameters. I will say that, construction loans in general, the agency can explore, in particular on its multifamily lending side, probably a little bit more aligned with the agency's sort of prior activities and sort of, it's more aligned with what the agency used to do, as well as other HFAs in the market.
Yeah, okay. I just, in the spirit of innovation, trying to figure out if there's a product that we can build to take advantage of this product that we've already created.
Just my 2 cents on that. I know at least of 2 HFAs that the one did one home builder loan, and is just using their equity to fund it. And then the second one it's almost like state directed to do something about it. And that's work in progress, but it's the same problem. Like new construction is challenging, and how do we sort of motivate home builders to do new construction for single family? And so the state is sort of like, empowered the HFA, I suppose, and provided funds to potentially create a program to do home builder loans. But that is definitely frontier right now in terms of just how to address that, that portion of housing problems.
Okay, thank you.
Any other questions? Thank you. Appreciate your presentation. So we're going to move on to item number 9 with Kelly Matson and Rebecca Franklin on the CalAssist program.
I think almost good afternoon, not quite sure the hour at this point. Rebecca Franklin, Chief Deputy Director, CalHFA. I'm joined with Kelly Madsen, the Director of Enterprise Risk Management and Special Initiatives. So I'm going to be, okay, I know everyone's going to be this is going to be like my last update for the CalAssist Mortgage Fund Program. I am passing the mortgage assistance, mortgage relief crown over to the capable hands of Ms. Madsen. So let's all relish in this moment. This will be one less hat I'm going to be wearing going forward. And one day there will be a board meeting where I won't present at all. We'll have cake afterwards. So as the board remembers, back in February, March, we had brought a proposal from the administration to use the remaining funds that we had for the National Mortgage Settlement Fund for 2 uses, expanding the length of our HUD-approved housing counseling program, as well as with that, we were working with the counseling network to define how they could best support victims of the LA fires, as well as other natural disasters, declared disasters, state of emergencies throughout the state of California. The counseling network isn't just located in, obviously, Southern California, so it has a broader reach. So that was the one use, as well as the other use was creating a mortgage assistance program in the similar spirit as the still currently running California Mortgage Relief Program, which was ARPA funded, a federally funded program, but that was due to the COVID-19 pandemic. And so that was a relief program for California homeowners for that. So if we go to the next slide, as I kind of said, that housing counseling expansion. So really focusing on foreclosure prevention, pre-purchase counseling, financial literacy, eviction prevention, guidance for the disaster victims, so connecting them to services, all of those things as they are either in a rebuild process or having to find suitable housing, et cetera. There's a lot that goes into that when you are unfortunately the victim of a fire or some sort of emergency situation in which you're displaced from your residence. The other part was the new thing. So we have been running the HUD counseling program for a few years. It started before my tenure here, actually. So we did is brought to the board, and so the board, because we were working as fast as we could, we made the commitment that we would bring back kind of the terms of the program itself as we shaped it, but we kind of are flying a plane while building it, while trying to find the tools and the materials to build it at the same time, which is why I love CalHFA, because life would be so boring without very hard tasks. But, thinking about the people we are serving, they're going through much harder tasks. And so we wanted to be at the table, being able to provide assistance. So a little bit about the program. It's really focusing on those California families who were displaced due to a major declaration of disaster or a state of emergency. So it doesn't have to be fire related. It could have been a mudslide. It could have been, flooding, et cetera. And so what the program is doing is providing up to 3 months of mortgage payments, a max of $20,000. So it's whatever's less. So if my mortgage payment is only $1,500, we're not providing $20,000 to that homeowner. It's 3 months worth of payments. And really that's to help kind of homeowners bridge a financial burden after a disaster. We know we're not going to be making a dent into their actual mortgage, but what we're doing is allowing them access to capital that would have been reserved for their mortgage payment to maybe their rental that they're in is 50 miles farther and gas is expensive. So, those kinds of options. It's just a way to support these families. And we really want to make sure that they see California as home and continue to see it as home as they go through the rebuild process, and that the state of California is here to help them as much as we can during this time. We are leveraging a lot of the best practices of the mortgage relief program, which most of you are familiar. I currently am the president of, and the lessons learned and the strategies of what worked, what didn't work. And that kind of comes out into the next slide, which is the kind of the eligibility. So we only have enough funds right now, we feel, we're about at the $10,000 award mark. So the Eaton fire and the Palisade fire at this point, the last count I saw was 14,000 units. Not all of those units would have met our criteria, but we need to be understanding that we've expanded the definition of who's eligible to not just those 2 incidents. So we want to create criteria that really focuses on the more vulnerable, the people with the current set of needs. So first criteria, the home that their residence must be destroyed or deemed uninhabitable at the time of application. So again, what we're trying to do is help people in that rebuild process that are currently facing that. So your home is either completely destroyed, have not rebuilt, or it's deemed uninhabitable. There was just significant damage. We are focusing right now the funds to households that are at 100% of AMI. And we're using the most current, the 2025 limits. They came out, I think, a few weeks ago or a month ago. The other thing is that we're doing is property value limits. So the principal first mortgage at the time of financing must be at or below the 2025 HUD conforming loan limit for the county in which the home is located. So this was a big lesson learned from the mortgage relief program. The half funded in the half legislation, it was the conforming loan limit of the year in which you financed the home. And I don't know if anyone's watched conforming loan limits since the 90s, but they are a little wacky. Yeah. So we were not able to fund certain homeowners with the mortgage relief program, the federal funds, because they would be like $200. They had financed $200 more than that limit. And the limits were like 100,000, 200,000. We're now in the 4, 5, even 8 probably in like the Santa Barbara area. So really understanding that it's the current conforming loan limit. We're trying to, make sure that the homeowner is still vulnerable and wanting to focus the funds on the most vulnerable. But I think that was a really big lesson learned from there. Also, just the normal from the other program, it must be at the time of the disaster, you must have occupied the home. We do condominium, single-family home, 2 to 4 unit properties, manufactured, permanently affixed manufactured homes, and you must not own an additional property. So if you had a rental property or something, then you can, obviously use that as your residence. So we're really trying to focus people that this is their primary home that was affected and they don't have another home in the state. And again, they have to have been a unfortunate victim of what we're considering a qualified disaster. So that, again, the state of emergency proclamation, which would be made by the governor of the state of California, or a major disaster declaration, and then that is made by the federal government. And that one of those 2 incidents has to have happened between January of 2023 and January 8th of 2025. So that's the criteria of the program itself and kind of the nuts and bolts of that. The other part that we've really learned through the mortgage relief program is the outreach and how do we get in touch with people. So we do have a lot of applicant support. We'll have a contact center. We have the ability to we'll gather emails so we can blast emails. If you've applied, we can contact you through the portal and the email system. If we do make any changes to criteria, we found it very successful that we code every denial of every application, the reason why, and we can blast anyone who was denied on a criteria that we are now expanding or changing. We will work with community-based organizations. We are very hand-in-hand working with CalOES and the recovery teams and the task force at the state level. So we're working through that network. We're also trying to keep in mind, I guess, as we design this program, the end user has shifted a little bit from the COVID program, right? And we're trying to keep that use case and that end user in mind of these people who have basically had their lives destroyed maybe in front of their eyes. And so when we're talking about what documents we're requiring and whatnot, we're trying to be very mindful and respectful of that. So then I'm going to turn it over to Kelly for the timeline of the launch, and then we'll take any questions. Thank you. I think our prior experience with the mortgage relief program has really enabled us to move at what I would consider lightning speed, bringing us up to where we are today in May. Just next week, some more intensive partner education will begin around the details of this program that will be conducted with housing counselors, community organizations, servicers, legal aid, getting a solid understanding, shared understanding of the eligibility requirements and things of that nature, ways they can help get the word out to folks that they interact with as well. That's going to be happening again very intensively next week in anticipation for a June 5th public launch of the program. We'll be holding a press event in Altadena on June 5th with a focus on essentially previewing that applications for this program will open a week later. We're really passionate about wanting to provide folks with time to do whatever they may need to do to locate the documents. First of all, learn about the documents that they would need to apply, find them if somehow they have burned along with their home, or if they need to get in touch with their bank, insurance providers, things like that. So making it very clear to everyone when the application will open, what they need to do to be able to successfully apply, with the intention of opening that application portal on June 12th. Once that happens, we'll begin reviewing for eligibility, and we anticipate that by July, grant funding will actually be going out the door and getting into people's hands, and that activity will continue until we exhaust funds. And with that, if you have any thoughts or feedback or questions about the program.
Questions from the board?
Yes, well, first of all, thank you, and I am familiar as a member of the board of the, oh my God.
Mortgage relief.
Thank you. So many acronyms. Of the outreach that was done for that and how you adapted and learned. This is a learning organization. CalHFA as a whole and their subsidiaries are learning organizations, and I saw that in action. Along those lines, though, would it be possible to get a list of San Diego County, when you talk about the community partners, just so I could take a look and see if there's somebody that we might recommend adding, I think statewide. Maybe we could just look at it sorted by county. Is that easily done?
Yes, we'll provide the list statewide of the certified housing counselors, because we do utilize them for this program, as well as the community-based organizations that we are in kind of the network that we're building. I know that we're going to be partnering very much with one specific, and then I think branching out from there, but we can certainly provide the list to the board.
Well, in the case of San Diego, of course, there was flooding in January, going back 2 years and a year and a half. And there was organizations that would not have been traditionally part of the mortgage program that were very much in the forefront of the relief and advocacy efforts. And so we'd just like to, Chicano Federation being one, the YMCA being another. So yes, we'd appreciate the opportunity to offer additional contacts.
And we appreciate the support.
Director Williams?
I just liked, in our previous presentation, we talked about our superpower. This is an example of a CalHFA superpower, to be able to see a immediate need, to craft a program, to find the resources, to pull in the marketing and the partners, and then to be able to do a successful launch. And so I just want to commend the entire team for the work and the outreach and the work that's yet to be done. But this is commendable. And I hope that when we talk about consolidating our agency's work and aligning our work to be able to produce housing funding and housing solutions in a more timely manner, in a more coordinated manner, that CalHFA does not lose its ability to respond in the way that we have been responding in an effort to collaborate with other departments. That's a real attribute of the agency, and I think it's very unique, and we have a track record of success. And so I commend you on that, and I also just anticipate that that won't be diminished in any way as we talk about collaborating and moving forward in the future. Thank you.
Thank you.
Secretary, go ahead.
Just wanted to echo the comments of the directors and just commend you, Chief Deputy, for your work around in the past and in the present and probably a little bit in the future on the program. And we just look forward to helping to get the word out. I mean, obviously, the staff, the team, the leadership, and, the survivors since the horrific events in January. A lot of us have still been in the trenches of trying to provide help and assistance. And so it's just a great honor to be obviously part of the board, to see us go through the process, and just know you still have us as a partner as we move to amplification. Thank you.
Thank you.
I'll echo the last couple of comments as well. This is really exciting, especially how responsive the state is being and the lightning speed at which from initiation to, I think, the timeline speaks to that. I'm just wondering on the, Rebecca, on the CBO participation, are you engaging with the OCPSC or Office of Community Partnership and Strategic Communications? It's a mouthful.
I do not think so, but I think that's
So it's an agency that the governor actually created in my office a couple of years ago for this kinds of specific actions, and now they've moved to what's now GoServe, former California Volunteers. The reason I bring it up is they have close to 200 CBOs throughout the country under contract. They're the group that actually helped on vaccinate all 48. So I think it'll be a good resource to connect to. They're at GoServe, and they have really incredible network.
We will definitely. We'll have to get the word out. Yeah, and that's the reason why we're delaying between the press event itself and actually the secretary will be the headliner, I think, and so we're excited to have her support there. But we want to make sure that we're not, leaving out any sort of specific community. That just, it's not about getting in line because you heard the press conference first. It's about everyone, really giving everyone equal space to be able to do that. Also, just for Director Williams' comments, I do think that I would be remiss to say that while CalHFA and this team here is phenomenal, and from a wild idea at the beginning of March to we've actually already done user acceptance testing on a whole new application online platform and built a website, et cetera, we wouldn't be nearly as successful if we didn't have the partnership and support of the administration and our fellow, not only within BCSH, but also CalOES and HCD and at agency itself. I think my career at this point has been deemed the mortgage relief person, which is fine, and I love that. I'm not a disaster recovery expert in any way, shape, or form. And when we learned about, the COVID-19 pandemic, and I mentioned earlier about the human-centered design background I have, really understanding the user, the use case, and their needs, we had to do that in a couple of days. And so that partnership, that focused partnership with people who spend their careers in this space is really what's going to make us successful in this one, in building out that. I mean, I can design you a relief program, but I'm only going to be limited by the program, like the mortgage part of it, really being impactful and understanding the needs of the communities we're trying to hit. That's done through the partnership, through the various state entities.
Thank you.
Great, yeah. I'm happy to connect you to the director directly so that you can expedite that.
Chair White, just to echo what Rebecca's saying, it really was the governor and his, the declaration of emergency and the quick response that really took place, and Secretary Moss and her stepping in and the team stepping in, right? So that really was the inspiration. So I want to fully acknowledge that, because without that overall guidance and that inspiration, we can be as nimble and responsive as we can be, but without the support and the partnership, that wouldn't exist. So I do want to acknowledge that in terms of the governor. And the work that we did on COVID recovery was arduous, and again, I really appreciate the team's nimbleness and learning from past mistakes. And so our constant need to make programmatic adjustments based on data is going to be what differentiates us from other organizations. So thank you very much for your commitment to do that.
Director Russell?
Yeah, I'm just put in mind, because we've talked several times today about superpowers that this organization has, as if they were kind of these ephemeral, ethereal things, and they very much rest with the people that we have here. And we're fortunate to have Dr. Franklin here. Knowing your background in human-centered designs, it clicks. All of a sudden, it's like, why are we making these programs? How is it that we are so responsive? And one of our superpowers is we have Dr. Franklin here as leading this organization. We have Erwin Tam leading our finance. We have so much talent here, and I just did not want to let this moment pass. We're here to support you. It's an amazing team, and you collectively are our superpowers, and thank you for that.
Any other comments? Thank you, Rebecca. Thank you, Kelly. Going to move on to item 10. It's our mid-session legislative update. I'm going to step back real quick. Any public comment on?
If any members of the public would like to make a comment, please come forward. Not seeing any at this time.
Thank you, Court. Floor is yours.
Great. Thank you. Good afternoon, everyone. Meji Tabar, Director of Legislation at CalHFA. Looking forward to giving you a legislative update. We are pretty deep into the budgetary and legislative cycles, both at the state level as well as in the U.S. Congress. And so there's a lot of things going on right now, both at the state and federal level. And so I'm going to do my best to give you the latest and greatest update. Move forward, yes. So I'll start with the state budget. Just because we just received the governor's May revise. So I just wanted to present the process or overview to remind you where we are. We are working towards a two-way budget on June 15th, where the legislature will come together and decide what their legislative priorities are, and that will move forward into the three-way budget, where we will see the negotiation between the governor's May revise and the legislature's priorities that will come out on June 15th. Let's see, the balanced budget must be signed by July 1st. So that's our target date that we are working towards. Of course, I want to make sure that we talk briefly about what was in the May revise. We heard earlier from the undersecretary about the governor's reorganization plan that did show up in the May revise. I would say that's one of the larger components of the housing proposals in the May revise. There are some dollars to help facilitate the two new agencies. And we are also seeing the focus on streamlining housing development from the governor, a focus on CEQA streamlining. There is also continued focus on homelessness and the encampment resolution initiatives. But again, we're kind of waiting to see where the legislature lands on June 15th. So more to come on that. But I did want to just briefly note there are no new dollars for housing programs in the May revise. All right, state legislative update. So this is quite a busy week in the legislature. Bills are still in the first house, but they are working towards the appropriation suspense file hearing, which we are anticipating for Friday morning. And so on Friday morning, if you're not aware of the suspense hearing process, I just wanted to briefly mention it, but bills that have a fiscal cost of $150,000 or more have to go through the appropriations process. And so this is a unique process to the California legislature where bills don't have a public debate in this process because they're at the end of the policy committee process, but bills will either proceed on to the second house or not. And so all that to say, a number of bills will not proceed after this week. And so I want to mention the bills that directly name CalHFA, but with the caveat that these may not actually be proceeding after this week. So the three primary bills that I wanted to mention are the first being AB 57, a bill by Assemblymember McKinner. This is a set aside for descendants of formerly enslaved persons within future rounds of Dream for All. This is, I believe I mentioned this in my January update, but this is part of the reparations package. The next bill I wanted to mention was AB 595 by Assemblymember Carrillo. This is very similar to the report that predated Dream for All. So this directs the state treasurer's office to look at a homeowner expansion plan focused on both moderate and middle income Californians. So we'll see what comes out of that. I know that report was very useful, but this seems to be similar to Dream for All in some ways. The next bill, which is a pretty large initiative, Senate Bill 750 by Senator Cortese. This recently got some press this last week, so maybe you've seen it. But it would essentially create a state-backed construction loan program at CalHFA. It was initially to support multifamily housing developments. It's recently been if it passes this week, it will be expanded to single family. This is heavily dependent on a constitutional amendment. And so all that to say, there is a lot to come, and there's a lot that would be required to move this program forward. So an interesting concept that we will continue to watch, but I'm sure we'll hear some more updates soon on this bill. And then lastly, I just wanted to mention the governor's reorganization plan, just the legislative component. We heard, of course, that it showed up in the budget, but there is a piece of legislation that would move this forward as well. So just wanted to make sure that we were aware of that. All right, moving forward to our federal update. There's a lot happening, as we're all, I'm sure, well aware of at the federal level. I wanted to make sure that we spoke about the federal legislation that is currently active. I think, while we don't necessarily see a lot of federal legislation pass. I think these three pieces of legislation are very exciting in the sense of the bipartisanship efforts around tax credits. And so hopefully there is some good opportunity here. The first is the Affordable Housing Credit Improvement Act. This was a bill that was introduced previously, that was reintroduced. As I mentioned, a huge bipartisanship here, and I think there are some exciting initiatives there that I know will be really important for multifamily development here in California. There are other bills moving forward. I just wanted to mention the Affordable Housing Bond Enhancement Act. This would increase housing access by modernizing bond tools, of course, important from the CalHFA perspective. Not a lot of movement on this bill right now, but we'll continue to watch it. And then the Neighborhood Homes Investment Act. This would create a new tax credit to build and rehab affordable homes. And so we'll continue to watch these bills, but I think more top of mind is probably the budget and tax bill that I believe has some new updates as of last night. So if we could keep moving forward. Yeah, okay, federal budget. So I'm sure everyone's well aware of the recent release of the president's skinny budget. This would increase defense spending and decrease non-defense discretionary spending. This is most concerning from the housing perspective in possible elimination of HUD programs. There's proposed elimination of CDBG and home, the consolidation of rental assistance programs into a single formula-based grant. So we're talking about Section 8 there. And a number of other things that could impact the work that CalHFA does, including the elimination of the CDFI funds discretionary awards, elimination of neighborhood works, cuts to the greenhouse gas funds initiative. So we'll continue to watch this. The updates that I just mentioned were in relation to the reconciliation and potential tax initiatives. There's a lot happening there. I will say the positive aspect of what's in the reconciliation are a number of affordable housing tax credit initiatives that would be really positive and would be kind of the biggest progress in housing tax credits in the last decade. And so I think there's both some highs and lows to what's coming out of Congress right now. But the next steps for reconciliation and tax bill are to go to the Senate. And so we anticipate a number of changes coming from there. So all that to say, things are moving a bit faster than maybe folks expected, but there are also a number of expected changes. So we'll continue to keep a close eye on that, and I'll do my best to update you all on those updates as we have them. So that is the update, both state and federal. I'm happy to take any questions.
Thank you, Maggie. Questions? Director Lamont?
Thank you so much. I think we've talked ad nauseum just the impact of the Great Recession on the CalHFA. And one of the things that I think we need to keep a close eye on is where things stand with the Consumer Financial Protection Bureau, what's going to happen with the ability to repay and qualified mortgage rule. And we don't want to go back to seeing the level of subprime loans that we saw pre-recession. And as we know, the impact that it will have on our agency. So just, I don't know if you've heard anything, but just I think we need to keep an eye on that.
Absolutely. And I haven't heard anything specific more recently about it, but I will say that the work that we do in mortgage relief helps us keep a pulse on what's happening at the household level. And then, our continued coordination with agency and other state departments continues to help us have insight into some of those things that maybe CalHFA doesn't directly see in some of our programs, but absolutely to keep a pulse on and ideally continued coordination with those other agencies.
Director Williams.
Thank you for both those updates. I serve on the advisory committee for the Consumer Financial Protection Agency. We are in a state of flux. They took the name off the building and shut it down. There is an effort to reinvigorate it, but we're just in a state of flux at this point. The other thing that we're in a state of flux is this whole idea about block granting rental assistance to the states. As someone who's the CEO of a housing authority across the country, we are waiting with bated breath to see the kinds of, we know that it will be negative. Just how bad? Is this a flood or is this a tsunami that's about to hit? And it's very concerning to us. So we'll keep our eyes and ears on that as well. But I appreciate your legislative update. I do think that it is, I understand that there are deficits, but I think it's tragic that we're in the middle of a housing crisis and we could be looking at a state budget that really does not provide any additional assistance at a significant statewide level to address that issue. I know there are 101 other issues that have to be addressed, but we keep using the word crisis, but we keep acting like it's not a crisis. It's one thing to say, it's another thing to do. And I think the agency, CalHFA, in its responsiveness, really is responding as if there was a crisis. But I don't know that that's being carried out in other areas and through other budgets that are reflecting that. So thank you. It's just a statement. It's not an indictment.
Any other? Director Russell?
No, I just would like to thank Mr. Williams for those comments because, yeah, it's a dark year right now financially, fiscally, and it's on many fronts. I guess one of the things when we talk about risk assessment, and I'm not sure that at the risk meeting if you discussed this at all, but I mean, what happens if, do we have PSH in our portfolio? No, okay, so we're that's one risk at least we can say we're not directly exposed to.
Correct. That would be HCDs more there. So.
Okay. Well, and we might be part of the same agency.
Yeah.
Then. Yeah. So these risks, I know this is unprecedented. I just will amplify Mr. Williams' remarks that we need to be acting like this is a crisis, and we are certainly working with legislators. My colleagues are to try to highlight the need for resources. Because we have some of the great progressive policies in land use and in entitlements, things like that. Without the money to build, we're not going to build the housing that is needed. But thank you, Meji, for your report and monitoring what has got to be a challenging menu of items to monitor. Thank you.
Any other comments? Courtney will open it up.
If any members of the public would like to make a comment, please raise your hand or come forward. None at this time.
Thank you, Maggie. So we'll move on to item number 11, which is informational reports. One was provided in the package. I don't know if there are any questions or comments on these reports from the board. Hearing none. I'll move on to item 12, which is other board items.
Try one more time.
Oh, there we go, public comment.
Oh, no, you're, I'm out of order, so
Sure. Any public comment on item 11? Yeah. We're good?
If any members of the public would like to make a comment, please raise your hand or come forward. None at this time.
Item 12, other board matters, which is if there's anything that we need to discuss or think about for future meetings. I could think of 3 that came up during this meeting. One was regarding local input in transactions. There's a discussion around AMI that I think is going to get, we'll have more of a discussion on that as we start to work through some of the items in our new Opportunities Committee, because it does contemplate going up the AMI spectrum, so I think we will get to those discussions. I think that's it. If there's any other.
I have a question on our next board meeting date.
It's currently scheduled for June 19th.
And I saw that on the calendar. That is a holiday. I don't know that that was understood when we set that date, but it is a holiday that is being observed. So I didn't know if that had any bearing on that particular date or that meeting.
We can take a look and we'll notify the board if we need to move the date.
All right, thank you.
Go ahead.
And did I hear that we're having a strategy session in July? I thought I heard, who was it?
That was
Director-
brought up.
Yeah, Prince mentioned that.
Hi, so right now, we're actually planning towards the fall for a strategy session. I'm not sure where the July information came from, but just to be clear, we're looking at the fall to schedule that time to continue on from the March workshop that we did and get a little further into our strategic planning.
Any other comments on item 12? If not, any public comment, final, item 13.
If any members of the public would like to make a comment, please raise your hand or come forward. None at this time.
I think we're done. We're at item number 14. Appreciate everyone. Appreciate everyone coming to this meeting. Look forward to seeing everyone next meeting. We're adjourned.